Welcome. For today's interaction, I'm joined by my colleague Akar Rastogi and Sanjay Chawla, CIO Equities at Baroda BNP Paribas Mutual Fund. Welcome, Sanjay.
Thank you for having me online. Thank you.
Thank you for taking the time out for this interaction. Sanjay, let's begin from where it all started. You started as a management consultant in 1990. How did the switch to asset management happen?
That's going all the way back to about 34 years. So let me tell you the truth. The actual journey began when I was in my 10th grade. And we were a family of engineers. My dad, his uncles, and everybody was engineers. And that's the time when I actually said, hey, I need to understand these stock markets. And maybe purely out of curiosity, Dad took me around, showed to a couple of bank managers because they were the hottest people around at that point. This is way back in early 80s. And so they just guided me what was all stock market all about. Then I decided that, from an academy point of view, I needed to do my MBA. But since the entire family was a bunch of engineers and I did well in 12th, and that's how it actually happens. If you do well, you get into engineering. That's what I did. But ultimate aim was to get into stock market. So I did my MBA, and unfortunately, at that time, there was no defined stock market analysts, etc. So I needed a bridge to get into that business. So I got into management consultancy to look at the demand, supply, look at the feasibility of the companies, etc. And that actually gave me a very good grounding to get into the equity markets. So that's how the journey has actually been. So it's on paper right from the time I graduated, but in reality, I was interested in right from my 10th grade.
Okay, so the interest was always there. Great. So you were with Aditya Birla Sun Life Mutual Fund when the global financial crisis happened. How do you remember those days? Any sleepless nights, or what are the lessons learned? If you can share that with us.
Sure. So one thing that I learned in the equity market, because I'd seen many such events, and when I joined the equity market in the formal side, I'd seen more bear markets than the bull market. At that time, each of the bull market, which lasted for a year, ended up in a bear market, which lasted for 3 to 4 years. So I'd seen the Harshad Mehta event, I'd seen the Ketan Parekh event, and surprisingly, of the surprise, I'd seen a political fallout after the Vajpayee government lost the election, where I'd seen a significant downtake. So honestly, the global financial crisis is something that we could see, but not really built into our model, okay, in terms of our actions. So we were well prepared. Obviously, it was a black swan event. The day it actually happened, it did impact us. But did we get unduly worried? I would say no. I think the past had actually taught us enough that please expect the unexpected. And, no matter how much training you may have, no matter how much education you have, you'll never be able to learn everything. And a lot of it is teaching you how to get to react on the job. And the global financial crisis was one event that we actually managed pretty well when I was in Birla Asset Management Company.
Sanjay, if I have to ask, how would you define yourself as an investor? What kind of situation excites you?
So, Akash, that's, a little bit of a philosophical thing. And, the first thing that I would say that I'm a very, very patient investor, very long-term investor. I tend to focus a lot on the traditional factors in terms of the fundamentals of the companies, etc. That's how I would actually define myself as an investor. Somebody who would still go down to the numbers, who look at the business aspect, who look at the financial modeling, who look at the return ratios, look at the valuations, not really getting swayed too much by, say, the market momentum or the flavor of the season, being grounded, because I've seen enough of these cycles in the past. So I've seen the dot-com bubble also, where people were actually going by the number of clicks. I've seen in recent times, the platform companies which came through, right? And uh, they had great business model. There was no doubt, but there was no cash flow, right? There was no valuation method which defined that. And that's something that we avoided, right? As recently as in the last couple of years. Uh, maybe initial period it was painful because that's where the momentum was. And at times it can be very difficult. But we stuck to our gun. So I tend to talk to my team that there's a religion that you need to follow. Okay. And the religion is fundamental. As long as you stick to the religion, it does not matter what is that religion. Each religion is based on certain principles. At Baroda BNP Paribas Asset Management Company, we have what we call the three pillars of investment. We call the BMV. We look at businesses, we look at management, and we look at valuation. And each of these parameters or each of these pillars have their own set of underlying themes on which they all stand. As long as they're all tick marking, we follow that process, and we have to be consistent. Very, very important as an investor. It's not the smartest guy who actually wins ultimately in the market. It's the guy who has the psychological nerve to see when things are going wrong, and you have that conviction to stay put on your investment. And I think that's a key thing for us. And that's something that only comes with experience. I've seen enough downticks. My entire grounding has been more in the bear market than the bull market.
Okay. So, going by your experience, like what kind of stock is a complete untouchable for you, like something that you would never buy?
Okay, so that's a very interesting question. There are certain principles that we go by. There are certain sectors that we may not really like it based on return parameters, which uh, if there is any cash transaction, we used to avoid, but things change after that also. And I think we've seen a lot of sectors evolving out there, more in terms of the way the business is being done, whether there's going to be, at the end of the day, predictability of the business that we look at, accountability of the management, and the valuation that you look at. So those are the three things that really we would look at. So if I look at any sector, which let me give you an example. Way back, I think it was 2010, when the sugar industry, okay, it was doing extremely well based on all the parameters where the domestic prices were also rising. Globally, there was a shortage. But however, the inflation in India was so high that the government came and clamped down very heavily. Okay. So you had a beautiful industry, which if it was left on its own, would have done extremely well. But you had a selling point intervention by the government. The area in which you could sell was being determined by the government, and the cane price also was determined by the government. So those are the red flags that we really look at. So we typically, when we are looking at a sector, we try to see all these factors that we have. What is under the control of the management and what is not under the control of the management. If there are too many factors which are externally determined, then we tend to have the risk profile raised out there. Okay, so that's in terms of the sector kind of a thing that we really look at, which we need to be careful out there. I think within the companies, we're very, very clear that is the quality of the management that we need to be very careful about. Now, that's a very historic thing when you define what is the quality of the management. And if you notice, in one of the pillars that we have for our investment, we focus a lot on the management, and people tend to look at corporate governance as one of the issues. I think for us, corporate governance is a filter before which a company comes into our investment universe. We really look at the management in terms of in a lot more deeper sense. How do they treat the minority shareholders? How do they treat the employees? What's the depth of the management? Yeah. How well is the decision making going all the way down the line? What's the span of the control? And the various other factors that we look at. So if there's a red flag on the management, no matter how exciting the business would be, we tend to be careful. I'm really not getting into where the balance sheet is questionable, etc. Again, that is knocked off in the basic filter that we have when we are looking at an investment universe.
All right. And you mentioned the filters, the red flags. What kind of a stock becomes a compelling buy for you? If you can give an anecdote also there.
So typically, if we like a business and the valuations are good, so that's typically what we would really look at. And I would also take it to the other extent where you look at a complete, okay, I need to own it when there's a massive gap between what our research is telling and what the market believes. So whenever that gap is the highest between what we believe in and what the market believes in, and that's a bold call that you have to take, right? Because the entire market thinks otherwise and you believe something else is going to happen, whether it's in terms of the business, whether it's in terms of the stock price. That's the kind of a compelling buy that we have looked at. So in the last 30 years, I would probably say that there have been many such instances, not only when I was on the buy side, but even on the sell side. There have been compelling stories that we've actually picked up, which nobody was willing to look at. Let me give you an example, and I think you'll find enough documentary evidence of such companies. But let me flag off one of them.
Mm-hmm.
There's a company called Solar Industries. Yeah. Earlier it was called Solar Explosives. This is way back in, I think it was close to 2010 or 11. That's when they went public, right? People did not believe in that company or the kind of business model that they had. I hadn't held the company, saw through the public listing, and subsequently the company's done extremely well. At the time of the listing, it was something like I think 450 crore or 500 crore market cap. Today, it's a 50,000 crore plus market cap. Okay. That's something that we've seen the whole company evolving over a period of time, transiting from a local company to a global company, challenging the global dominant player in the explosive business. And of course, they've actually diversified into many other things right now, into defense, etc. I think those are the compelling stories. And I can anecdotally talk about another one, which was a very interesting thing very early in my career. This is the time when the fridges were just Kelvinator and Godrej, right? And that's when Coke and Pepsi had come into play. Coke had just come and, sorry, the Coke was already in the market and Pepsi was entering. And they came up with some very innovative open glass refrigerators. That was something, a novelty.
Mm-hmm.
All you had to do is just go behind those refrigerators and see who was the manufacturer, right? That time, the total market for refrigerator was about 50 to 75,000 units per annum. Even if you do a simple math in terms of what does it take to supply to all the merchants out there, and I think we had a 10-bagger out there. So those are the compelling things where there's a significant gap between what market believes and what is the actual thing which can actually generate significant returns.
Okay, you cited these really interesting anecdotes. If you could, elaborate on the red flags that make you initiate a sell decision.
So typically, if we already have it in a portfolio, it would usually mean that it would have qualified a number of parameters that we have. And if I go back again in the same BMP principle, I think the biggest red flag for us is always on the management. So if we discover something which is not right or something which we discover later on that, look, it's not ethical or there could be some issue in the books, that's a big red flag for us. Okay.
Yeah.
The second part is in terms of the business environment. If there's a change in the government policy, which can have a significant impact on the business of the company, that's another red flag. And the simplest of all is, when we make an investment in a company, we have a certain investment thesis based on which we look at investing. So we believe that A, B, C would be happening in a certain parameter. Obviously, when we are looking at investment, we tend to look at it from a long-term perspective, 3 to 5 years. But that has to be broken down into smaller period, and we have to monitor the way it is panning out. The easiest thing is the growth numbers that we are expecting are different from what the company is actually delivering. So it's a slow process that we need to liquidate. The one where we don't wait at all is when we discover something different than what we thought was there. And I think if you look at my portfolio, I think about 6 or 7 years back, we had a company called PC Jewelers, and we sold that in a hurry.
So, Sanjay, if I may just ask, how do you gauge the actual quality of the management? Like you mentioned that, that's very important. So, besides the numbers and the accounting numbers, what is there actually that you look out at it?
So there are many softer aspects that you need to really focus on, when you interact with the company, and that's something that we do very often. We interact with the company at least, if it's in a portfolio, at least once in a quarter.
Okay.
Not only that, we actually tend to look at the entire supply chain and gauge what's actually happening and how are they behaving with the suppliers also. Whether they're being paid on time, how are they reacting, how are the people treating them. We tend to look at very informal checks also with the other employees, etc., in an informal manner to see. It could be as simple as the salary is being paid on time or not. We've seen cases out there where in certain companies where they look very great on paper, but it doesn't work that way. So those are the softer aspects that we look at. Uh, it's not just the top guy that we should be speaking to. It's across the company management that we tend to look and focus on. And there are a lot of softer aspects in terms of how are the marketing people behaving ethically or not so ethically, how are the finance people doing, how are the manufacturing, how's the shop floor guys behaving, right? So there's a very interesting anecdote that I keep talking about. I visited a plant in Gujarat, and I'm not going to name the company. All the workers were uh, Gujaratis, okay? But all the signs were all in English about the safety aspect. So what do you make out of it? The signs are put up for me or for the foreign visitors, or is it for the workers? So that's what are the softer aspects that you need to watch out in the management quality. And that is something that we are very particular. So within the space, I would bifurcate it. The large companies are all clear, so we need to focus on the business part. It's the mid and the small cap companies that we need to focus a lot on the management quality.
Okay. Thank you. And now it has almost been 2 years, since the merger of Baroda AMC and BNP Paribas. So, what changes do you see? How has it, strengthened the investment team? And, if you can just tell us about some advantages that you now have versus the pre-merger era.
So that's a great question. I mean, it's been long overdue because, the merger was announced sometime in 2018 and early 2019. It's taken about 2.5 years for the merger. COVID did not help because there was certain decision making for the merger which got postponed, and it had to go all the way to the regulatory bodies in India, the cabinet secretary, etc., for the approval for the merger to happen. So during that time, there was a lot of uncertainty in terms of the direction, and most of the budgets were kept on hold in terms of investments, in terms of growth, in terms of the products, etc., in terms of the team. I think in the last 2 years, or rather 1.5, 2 years, we've seen a couple of things. Of course, at an individual level, it removes that uncertainty, what's going to happen with the merger, what will happen to me? That's always and it is always very unfounded. But nonetheless, we are all human beings. From an organization perspective, I think we've seen a lot of new products being introduced by the company to fill up a lot of product gaps that we have in our portfolio. Uh, the good part is the AUM has become sizable for each of the schemes, which is giving you an advantage in terms of the size. It's not too small to attract a lot of attention from the channel partners, and it's not big enough that we cannot act very nimbly compared to some of the larger funds out there. So that's a very unique advantage and well positioned. We're very well positioned in that segment. And the biggest advantage that we bring to the table, and I think that's the critical part of the heart of an EMC, is the investment team. Uh, we've not only been, and this is a thing that we started off with, 1+1 is more than 2. And we've actually demonstrated it in our investment team. Uh, both Baroda AMC and as well as BNP Paribas AMC had an investment team size of about 3 to 4 in each of the companies. So logically, we should be about 8 people. We're actually 14 people right now. So we've actually invested in where it really matters in terms of the people, people who can add alpha to your portfolio and at the right skill set. It's not just the numbers, but the people with sheer experience who are actually managing the portfolio very effectively. And that is the key difference that I see post the merger. Of course, I can go on talking for the organization as a whole in terms of the number of sales touch point that we've grown to be closer to the to be closer to our customers, etc. But let me just stay focused on the investment part of it.
Sanjay, moving on to your balanced advantage fund, can you take us through the process that drives the asset allocation of that fund?
So let me just get a little bit into history. The unique part is Baroda BNP Paribas Balance Advantage Fund is a model-driven fund where we determine what's going to be the net equity based on our model. And the genesis of this model is when we started off somewhere around 8 years back. There was a need felt that look, we have a product gap. There were very few people in that category. I think there were about 10 or 11 players only at that point. And it was a category which was exciting. And my boss came and said, hey, we are launching this fund, so you be prepared. And the first question that I asked is, hey, just because you're launching, why would anybody invest in it? So we need to find a unique way of investing or looking at this product, right? And that's when we went back to the category and we studied how were other competitors, how were my other peers making a net equity allocation. There's a lot of science which has gone behind this product. Science in terms of determining what should be the net equity allocation, which is between 30 and 100%. Most important thing is how do we determine what should be the net equity allocation? Okay, whether it should be 30%, 40%, 50%, how frequently are we going to change it? On what basis are we going to change it? And we almost spent 18 man-months, an amazing amount of computing power to determine how should we look at it. Some of the fundamental factors that we looked at, or the basic principle on which we looked at was, we felt that a typical fund manager is determined by basic emotions like greed and fear. He's no different. Okay. He may pretend, but he's no different. It only comes with sheer experience. So how do we remove or eliminate that factor when he's determining the net equity? The second principle was how frequently we needed to do. Again, that was a statistical exercise. And more important, the third principle that we used was we are a fundamental house, and the only thing that we understand is fundamentals. So we look at fundamental factors. So we spent 18 man-months to determine what are the factors that we should be looking at, what fundamental factors should we be looking at, how should we model that into the thing, come up with a statistical model, which would be a net equity deterministic model. And that's exactly what we did in this. So it's a model-driven exercise. Every month we rebalance the portfolio. There are fundamental factors that we use, which tells us what should be the net equity based on the fundamental parameters. Once the net equity is decided, then we have a top-down approach in terms of what are the sector calls that we would like to take, and a traditional bottoms-up approach in terms of stock picking. And that's how we determine in this product.
Okay. So, Sanjay, as you mentioned that the equity allocation is decided basis the model, but what I have seen is that usually your fund has a higher equity allocation in comparison to other funds in the category. Even now, it's like around 65%. The category average is 56%. So, like, what's the thought process, for this particular thing which is imbibed in the model?
Sure. So, Akar, what's actually happening is there's a certain process that we follow, and that's something that we don't compromise in. The model tells us that this is the way it has to be done, and that's what we follow. Most of the other people in the industry follow either still the traditional method of the fund manager determining what should be the net equity allocation. They have certain parameters for fundamental. We use four factors, and we believe that's a very holistic manner of looking at it. And these four factors, in our method, of when we were back testing it, was explaining the market movement with a 90% confidence level. So statistically, that's a great number to have. And thirdly, there are certain people in the peers who are actually using what they call the dynamic or the momentum factors. We don't use any of those. So that's probably the reason why there could be a difference in terms of the asset allocation. The proof of the pudding lies in eating. I think we need to look how has Baroda BNP Paribas Balance Advantage Fund done vis-a-vis the other people based on the asset allocation that we've got. I've seen the asset allocation for all the peers actually increasing consistently from where it is, closer to where we are right now, rather than me turning around the asset allocation. So I just said that it's a certain form of a religion that we follow. If the model says that we need to do this, the investment manager has no say except to follow that, what the model says. There's no deviation for the investment manager from what the model is telling us in terms of the net equity allocation.
So, like any changes that you plan in the model, like or like you're completely satisfied the way it has been running so far?
So, this is a very interesting question. And the reason why I'm saying is we spent a lot of time fine tuning the model in terms of what factors to look at. We started off with 47 factors. We zeroed down on 4 factors, and we kept challenging at every stage why we should include this or why we should not include that. And this thing continues because we believe that market is very, very dynamic, and you need to keep challenging the status quo. Just because it's done well doesn't mean that it'll continue to do well. So when every month when we are rebalancing, we keep challenging ourselves that why should we continue with this or why we should not. And that actually helps us to keep us on the toes. When we backtested this model, we did it over 12-year financial period. So the actual backtesting was for 17 years, and we have almost 5 years of actual history. So it's close to about 17 years of actual data that we have. And we've gone through multiple cycles. We've gone through multiple wars. We've gone through multiple rate cycles. We've gone through multiple financial crises, many crises, etc. So far, it's withstood a lot of these external shocks. And the last 5 years itself, which is actual NAV movement and actual performance, seems to be indicating that, look, there's no reason why we should be changing the way we are looking at investing from this model.
Okay.
But it's a constant thing that we keep evaluating. And that's what keeps us on the toes. But so far, there's no need for us to worry or change the model.
Okay, so would you mind take us briefly through the four factors if that's not a business secret,
No. So I think it's a very simple this thing. We look at the P ratio,
Okay.
the price to book.
Mm-hmm.
We look at the dividend yield and the earnings yield gap. All the four factors have the market price out there. And the way to look at it is P ratio is related to the P&L of the company. Price to book is related to the balance sheet of the company. Dividend yield is the cash flow of the company and the propensity of the management to share it with the investors. And earnings yield gap is nothing but 1 by P ratio minus the 10-year G-Sec rate. So it's the alternative asset class that you could invest. And it's a trade-off between should we be looking at equity investment or the debt returns. So those are the four factors that we really look at when we are looking at making the asset allocation investments out there. Asset allocation decision in terms of the net equity allocation.
So you're saying you stick to these four, principles, and even if something drastic happens in the market, which might warrant a drastic change in the asset allocation, that does not happen, and you stick to this method.
So we've had, when we back tested this model, what we discovered that, there are 4 or 5 types of market. You have a trending market upward or a trending downward. You have a sideways movement, and then you have a sharp up move and a sharp down move. So we slice and dice the performance, and we found that the only time that this fund, a Baroda BNP Balance Advantage Fund, tends to underperform is when the markets are rising very sharply. Okay. Otherwise, in all of the market condition, it tends to give you a near equity fund return with half the risk. What do I mean by that? In a backtesting model, we found that the returns were similar to a full-fledged equity with a net equity allocation of 52%. Yeah. So technically, with half the risk, you're getting a near equity return. In actual NAV performance, my average equity is about 57 or 58%, okay, for the last 5 years. And the returns are almost similar to a full-fledged equity fund. We found that during the sharp up move this time around, we actually were doing better than what the model had predicted. So to that extent, there's no reason for us to believe that we should not continue with the model.
So, Sanjay, we at Value Research generally have a view that hybrid funds with a static asset allocation are much better than a balanced advantage or a dynamic asset allocation fund. Simply because they have more certainty wherein the investor knows that the asset allocation aligns with his time horizon. Like if he has a long horizon, so he can stay invested higher into equity. So, what's your view on this?
So I think as a category, I would tend to agree. And it also depends upon how is the asset allocation being made. Okay. So if you have a static allocation and if the market goes down and you don't have the ability to change the net equity allocation to a level which is comfortable for you, then you would tend to lose out. So the call is really on how do you time the right asset allocation? And the reason why a Baroda BNP Balance Advantage Fund has done well is when the markets are high. Okay. And this is a very colloquial term that I'm using, and it should be when the markets are expensive. Okay. That's when you should be actually reducing the exposure, net equity exposure. But then that's not the way it actually happens with most of the retail guys. Okay. And vice versa. So when the markets are cheap or when there's maximum fear in the market, when there's no change in the earnings, that's when you should be actually increasing your net equity allocation. A typical aggressive hybrid fund has a defined boundary wall between 65 to 80. In case of Baroda BNP Balance Advantage Fund, the boundary wall is between 30 to 100. So the question that you should be asking is, have you ever come close to 30 or have you ever come close to 100? The answer is almost yes for both the cases. The lowest we've gone to is about 37 or 38, and the highest we've touched is 90. So if you get your timing right, and this is something very important in our balance advantage category, if your ability to get your net equity call is right, then you can potentially do better than a fixed net equity allocation fund.
Okay. I was also looking at the portfolios of your flexi cap fund and the ELSS and all those diversified categories. So I realized that you are bullish on the construction in the real estate sector vis-a-vis the category averages. So what's the promise that you see over there?
So, we tend to split both the construction and real estate a little separately. And typically when we talk about construction, we are looking at one single company, right? Larsen and Toubro. That's the one which we own as a house. As a house, we basing the entire investment thesis on three factors, what we call the three C's. We believe that the credit cycle was very strong. That's something that we played out in the last 1.5, 2 years. We believe that the consumption cycle will continue to be strong. And the third was the capex cycle. And I think construction is a classical play, or let's put it, L&T is a classical play on the construction cycle. Okay, so that's why as a house, you would see that by and large, we are overweight all across in all our funds, because there's a lot of debate internally that we have and decide, while each fund manager is free to choose what they want. But, depending upon what kind of a fund that they are running. But as a team, we discuss all ideas, and there's a lot of sharing which actually happens. So something that we believe in is on the infra space, the capex cycle, and L&T fits in very well across board out there. On the case of real estate, I think what COVID has actually taught us is people have realized that you need bigger homes. That's where they tend to spend time. Because of COVID, a lot of IT sector people were going back home. There was a lot of vacancies in various pockets of market. With back to office, you've seen these vacancies evaporating, and during that time, we had seen a significant slowdown in new construction pickup or the new project launches. And suddenly with back to office, we've seen a huge demand both in terms of rentals as well as need to buy a new property. Plus, the COVID also led to the realization that you need a little bigger space, you need better space, or maybe an extra room. But that's where it's very important, people staying back home, realizing how difficult it is. And in general, I think there's a change in the attitude of people. So I think both these factors put together has led us to believe that we need to be looking at this sector very favorably. And if you look at the performance, I think it's actually reinforced our belief that the call that we took a year and a half back, it was correct.
Sanjay, I enjoyed the stories that you've shared through this half an hour long chat that we've had. But before we close this discussion, can you take us through, in this over 3-decade-long career of yours, can you take us through some investment decisions of yours that you're really proud of?
Well, there are so many of them, and we could probably spend hours and hours. And, some of the things that I just spoke about, Kelvinator was a classical example. I can go back to my first investment also. This was, I actually bought HDFC Limited way back in 1987. So that's something that I've actually held on. One of the key lessons is if you identify the trend early and you stay invested, you can make significant amount of money out there. And that is something that I would like to leave you guys with, and your viewers and listeners, that if you stick to early decision and stay invested, whether it's through mutual fund or through equities, etc., if you have got the sector and the stock call right at the right valuation, I think you can make lots of money. I have a lot of interesting stories in terms of the way to look at it. But particularly, I'm very proud of in recent times that at the time of the COVID, the way I saw digitization happening and the way the pharma industry reacted, those were the two sectors that we became significantly overweight as a house. And it panned out so well for us. Yeah. And we actually went underweight of the banking sector. Again, that's worked extremely well at that point. And the way we took a top-down call in terms of the sector of the credit growth in the last 2 years, the banking sector has done extremely well. And then we're actually flipping from one segment of the financials, from the banks to NBFCs and maybe to insurance. Those are the things that I'm particularly proud of.
Okay, and if I may ask, like inside any investment decisions, like about which you are kind of embarrassed or you have a regret about?
Well, there's so many of them, and I would tend to typecast them in terms of certain, regions that where I have to definitely read the annual report a lot more deeper, get a sense of, I've seen enough of stories coming out of granite companies. I've seen enough stories coming from APIs. So those are the things that one has to be careful about. The cash transactions which actually happen. So we need to be very careful if there are leakages. Trust me, that's something that has actually we need to be very careful of.
Great. Thank you, Sanjay. It's time for us to wrap up this chat. We really enjoyed this, conversation with you. Thank you for taking the time out and joining us. And, we hope our viewers benefit from the insights that you've shared.
Thank you for having me.
Thank you so much, Sanjay.
Thank you, Ruchira.